Many traders like to trade on shorter time frames to make quick profits by scalping in the forex or stock market. Others are price action traders. They look at recent price movements to decide when to trade, instead of using technical indicators. But can you do both scalping and price action together? Yes, you can. In this video, I'll show you an easy price action strategy for scalping on shorter time frames. This strategy uses a trend line and a double top or double bottom pattern. As the name suggests, this price action pattern is about observing two high points at an important resistance level for a double top and two low points at a crucial support area. When the market gets pushed back from this level, not just once, but twice, it's a sign that this level is likely to remain strong. A double top pattern occurs when the price can't break through a level it reached before. This indicates a strong resistance point where sellers have the upper hand. Eventually, buyers give in, and you see a double top pattern. Conversely, a double bottom pattern is the opposite of a double top. Initially, the price drops to a low point and then rebounds. After this bounce, the price tests that same level again but can't go any lower. This double bottom pattern indicates an area of support or demand where buyers are in control, overpowering the sellers and forming this pattern. When you spot these patterns, it's a signal that the price is likely to reverse its direction. These patterns indicate that the market's momentum in its current direction is slowing down. When the price can't make new highs or lows but closes near a previous high or low, that's when you see a double top or double bottom pattern. On a 5-minute chart, you can observe that after the double top pattern appears, the price usually starts moving lower. When a double top or double bottom pattern forms successfully, it typically indicates that the price is about to change direction. Now, here's a crucial point to understand. Not all double top or double bottom patterns are perfect. It's quite rare for the price to form a pattern at precisely the same price level. A more common occurrence is a double top or double bottom with a fake breakout, especially on shorter time frames. Fake breakout patterns are among the most important price action trading patterns to grasp because a false breakout often strongly suggests that the price might change direction or that a trend could resume soon. Think of a false breakout as a market trick. It appears as if the price is about to make a significant move in one direction, but then it quickly reverses, deceiving those who thought the breakout was real. Often, beginners enter what seems to be an obvious breakout, only to be pushed back the other way by professionals. As a price action trader, your goal is to learn how to use double top and double bottom false breakouts to your advantage instead of falling prey to them. A common misunderstanding is that you can start trading the double top or double bottom pattern as soon as the second top or bottom forms. The reality is that a double top or bottom is only confirmed and thus ready for trading when the market closes below its neckline. The neckline is essentially the intermediate high for a double bottom pattern or the intermediate low for a double top pattern. When this reference point is breached in the opposite direction, it confirms the pattern. Once the pattern is established and validated, the price changes direction. When you combine these patterns with the concept of trends, this approach becomes even more powerful. Now that we understand the double top and double bottom patterns, let's see how we can apply them to scalping. Most trading books typically teach you to use double tops and bottoms as reversal patterns, but I have a different approach. I use them as continuation patterns. That means a double bottom or a double top, when they appear within a trend, can actually signal that the trend will continue. To do this, you first need to identify the main trend on the shorter time frames and draw a trend line. An upward trend line is drawn when you observe higher highs and higher lows, while a downward trend line is drawn when the market makes lower lows and lower highs. If you don't know about trend lines, I have created a full and detailed video on our channel. The video link is in the description, so please watch it before we continue with this topic. Next, you should look for potential setups, such as the double bottom or double top pattern, that occur close to this trend line. When this pattern shows up, you can confidently trade in the direction of the trend. For instance, if you have an upward trend line, search for double bottoms near that trend line. Conversely, if you have a downward trend line, seek double top patterns near it. Let's examine a long setup with an example. In this case, we've identified an upward trend line on the 5-minute chart, and we patiently waited for the price to form a double bottom pattern. This pattern occurs right near the trend line, which enhances the credibility of the double bottom pattern. Since we already know that the price is in an uptrend, the confirmation of the double bottom pattern near the trend line increases the likelihood of this setup succeeding compared to trading it on its own. You should enter the trade when the price breaks above the neckline of the double bottom. However, it's crucial to understand that the initial breakout is not what triggers the trade setup. What we're looking for is a retest of the neckline as new support. This ensures a favorable risk-to-reward ratio, which is crucial for successful scalping. Take note of how, in this example, the market retests the neckline and treats it as new support. This is where we have the opportunity to go long. To determine a potential profit target, you can project the distance from the double bottom's resistance level to the neckline. Then, extend the same distance beyond the neckline to a future point higher in the market. You don't always have to wait for the double top or double bottom patterns to form right next to the trend line. These patterns can appear at various points within the uptrend. The crucial thing to keep in mind is that the trend line should still be intact, and the price hasn't moved too far away from it. When the price strays too far from the trend line, it can revert to the mean or snap back to the trend line. This can lower the chances of the double top or double bottom pattern being a successful trade setup. So, as long as the trend line remains relevant and the price hasn't drifted too far, you can consider these patterns as potential trade opportunities. Now, let's discuss another scalping scenario involving a downward trend line and a double top pattern on shorter time frames. In this example, we have a downward trend with a bearish trend line. The price creates the first top and then forms another top. It's important to note that this pattern is close to the main trend line but doesn't break through it. We draw the neckline at the bottom between the two tops of the pattern. You initiate a short trade when you identify the breakout, and the price retests the neckline. Always remember to protect your open trades with a stop-loss order because there's no guarantee that the trade will go in your favor, especially when you're scalping. The optimal place to set your stop-loss order is just above the second top. If you're willing to take on higher risk for a potentially higher reward, you could place your stop-loss closer to the entry point. Here's a crucial point to remember. A double top pattern isn't technically a double top until the price closes below the neckline. Without the neckline being broken, it could simply be a period of consolidation or ranging price action. The key takeaway is that a double top isn't considered complete until the market closes below the neckline. Attempting to enter a trade before this confirmation can lead to trouble. One of the most critical aspects of trading a double top is to avoid entering the trade before confirmation. Wait for the support level to be convincingly broken, typically with an increase in trading volume. You can also pay attention to volume as an extra confirmation that the neckline breakout has momentum. However, indicators tend to lag behind price movements, which can be problematic for scalping. Scalping demands quick analysis, swift decisions, and rapid execution, making price action a well-suited approach. Price action trading is fundamentally focused on speed and efficiency, and it may yield better and more consistent results in the long run. If you found this information helpful and valuable, please consider leaving a like to show your support, subscribing to our channel, and hitting the bell icon to stay informed when we release new videos.